Good morning. Sound check, 1, 2, 3. If you can hear me, I would really appreciate if you can type in chat box that sound is good. So what we're doing right now, we're showing you the disclaimer. Please take a moment to read it. Welcome to the sharpening session. My name is Josip Kosik. Today is April 23rd after the big crash. Welcome, Mark. Welcome, JB. Good to see you. Please take a moment to read the disclaimer because they are for educational purposes only, all the examples that we have. And as you can see over here, this is an email address where you can contact me in case you have any questions. Also, we have a website that you can post the questions, and this is a website where you can get in touch with me. You can read some of the notes from the last session that we had. So obviously we had this trade. We're going to go over it in a moment. And I would like to start today with examining what happened on the market over the last few days. And one of the easiest ways to do that would be to look at the monthly, because if we end up looking at for instance, FinViz, the big picture is kind of depressing because here's a FinViz from Friday close, and you can see that Dow has almost lost 1,000 points, which is almost down 3%. Nasdaq has lost 2.5%, and S&P tried to rally up in the last hour, and then it just completely fell apart. So what I'm going to do this morning is very simple. I'm going to go over the monthly charts, and I'm going to then prepare myself for the following week, which is going to be quite exciting week. So if you're ready, I'm going to pull up my monthly chart, and I'm going to slowly go over each of these charts piece by piece. So I'm now enlarging the Dow Jones Industrial Average, which I showed you just a minute ago, has lost on Friday nearly 1,000 points. Well, a lot of time people think 1,000 points is a big deal, but as I pointed out to you, it's not even a 3%. However, what does that mean in the bigger picture of things? Well, in the bigger picture of things, it means that we have tested the high of the previous month right here. So this is a previous month, and this is a high of March. And look what the price has done. It has went above, but didn't close. And then it came down with the vengeance Thursday and Friday. So this whole price action that I'm showing you, if I switch this just to the daily, it's going to be quite obvious. So that line that I drew, I'm going to redraw again. It was right here on a Wednesday that we closed at the high, and then we gapped up. So the stock market tends to do the things that they fool the people in such a way that at the time, everything looked like it's a bullish trend, like everything looks good, because we were for about 3 days making these higher highs and a higher low. We actually had a gap right here, and then we gapped in the morning even higher up to here. This is pretty much where we opened this blue line. And then out of nowhere, there was what is called liquidation break. And what the liquidation break means is when institutions that are long are deciding all to liquidate, and here's a key word, at the same time. So when they all liquidate at the same time, what's the effect? Well, the effect is very simple, that the price action simply goes straight down. So on on a Thursday, we opened right at this level and we actually ended up heading lower. But at that time, we just actually only closed the gap and went a little bit deeper into the range. So really, the uptrend at the time still wasn't completely threatened. Yeah, I'm reading here, Mark, what you suggested. Almost closed the trade Thursday morning before Jose's session, decided to wait for them and to expire and got stopped out on all 4 trades. Yeah, that's pretty much what is in my paper trading account. I'm going to go over that in a moment. So this is the thing that the first thought, market, that comes to you is most of the time the thought that you shouldn't guess. And it's actually good that you did that in the paper, because you learn for the future whether or not these things are right. So I have here information. How did market look exactly on the Thursday morning? Let me just pull it up here because I have a picture of it. Okay, I'm going to share this with you because I was looking at this on Thursday morning. This is a Thursday morning Finviz that I took a note, and it gapped up. Oh my God, we're going to go over that in a moment. Let me just finish this. So this gap is very, very unhealthy. So that's mean we gapped up and we are hanging out on the threads. And as the time has passed, I was kind of recording this on my end, what was really taking place. Let me take a look here and show you the another one here. So this is another one here later on that day that I'm gonna pull it up and show it to you, because I was taking the snapshots when this whole trade came in danger, and the whole trade came in danger when we came down. That's Thursday morning. If you're looking right here, Mark, I'm showing you the date. Right here is a date, and we're gonna go over that and go into detail. So that's the date when that gap that originally was unfilled ended up getting filled. Okay, and then the price action went even lower on all of them, on the NASDAQ, on a Dow, on an S&P. That line in the sand for me with this bounce was indication, uh, if the price goes lower, then I need to exit this. So at the time, this was still 44.20, and if I'm not mistaken, the trade that we took was at the 43.70. Is that correct, Mark? You can type it in. I think from my memory, that's pretty much what it was. That should have been right there. That line in the sand, this little pop to the upside. It looked like a reversal. We're gonna go higher, and then when we didn't, that should have been exit. And anyway, let me just continue that. I'm gonna continue that um, observation. So we came and we filled the gap. So obviously on a chart of the Dow Jones, the gap fill is at this level right here. And that would be the same on all of them, and I'll revisit all of them and discuss that. But what happened the next day? Yeah, 43.70 on the bigger one and 43.80 on a one single contract, right? And then in the morning, between a Friday and a Thursday night, we have gap down again, and we left that gap intact, and this gap is still in place. Obviously, we had a tiny little bounce, which almost doesn't really matter. So when you're looking at the daily, this kind of is not as clear as when you look at the weekly. So when you look at the weekly, what is really taking place, that we have, for about the 4 weeks, we've been consolidating, which means we've been kind of going sideways and trying to resolve where the market is going to go in a relationship to the price range. And that price range was really contained for basically an entire month in a way that it just looked like it's gonna go either above, and then it did, or it's gonna go below, and then it came down with a vengeance. So let me run this on a SPY, because SPY is the one that we took a trade on, and I'm gonna again start with the monthly. So again, technically speaking, we're still within the range of the March bar, and the reason why I'm saying we're still within the range, because we did not test the high. Dow did, but the S&P didn't, and we're approaching this low of the. This is exactly the February 24th low, right? We're approaching the February 24th low. And if this area gets lost from a February 24th, there's going to be look down, because we might actually go even lower. We might go even lower, okay? So let me now finish up this analysis by looking at the QQQ, or a Nasdaq, that was extremely weak, and everything started with the Netflix actually missing their earnings on that Wednesday to Thursday night. On a Thursday to Friday night, Tesla came out and they beat the earnings, which was one of the reasons why everything was up. And then, as you know, everything sold off. So the distance between this February 24th low and a current price action on a Nasdaq is really, really petite. It's really, we're talking about just this little area. While on a Dow, as you can see over here, if I switch on the Dow back to the monthly, so we're comparing the oranges with the oranges, that distance is quite a bit. So that distance still has about several thousands of Dow Jones point before we go lower. But the one that we were in a trade, the one that we are in a trade was not the IWM, but I'm going to just go over this quickly, IWM, so then we are done with the IWM discussion, which looks very much similar to what also the Dow, not the Dow Jones, the QQQ is looking, which means it's near. It's definitely near. So the last piece over here that I'm looking is SPY, which did not have at all any tail, because we closed dead on a low, as you can see right here. This is a Friday, FinViz, February 22nd. We attempted to go higher, so that's mean the shorts were trying to cover, meaning take the profits, but then institutions came back in and they just dumped the more stuff in. Mark, quick question. We didn't have an IWM trade. Well, we did have an IWM trade on a paper, right? Did you do it with the one contract, that trade on SPX, or how was it? If you can type that in for me, so I will know. So I would know that. So having said that, I'm going to now pull up the options with options and look at the price action that, and I'm going to look at exactly the daily. Okay, so we're coming into the UFOs. We had the other UFOs that were simply peers. The price has lost 9-day exponential moving average and has proceeded lower. And we have currently first down day out of the possibly 3. So that's mean this move down can continue. Thank you, Mark, for checking. We want to make sure that we know the correct information. So the question becomes at this point, do we now switch back to the bearish bets, or do we now anticipate the move up, right? Because if we anticipate the move up and switch to the bearish bet, there's a high possibility that we may actually ended up on the wrong side of the trade. So it's very important now not to go in a revenge mode, but to actually be very much focused on what the market information is actually telling us. Is it going lower or is it going higher? So as soon as you check mark, you can type it in for me, and then we can take a look. So I'm pulling up here my account too, and I'm going to look at it. On my account, we had a trade with the 10 on a SPX, and profits and losses right here on SPX XLC. I'm going to go back in time just for 1 day. So this is a second. This is a second. And when we got stopped out, we ended up getting hit for a $3.10 debit, and the higher one also got hit for $3.10. So, Mark, when you check, maybe you can share with me exactly what the outcome was. So, recap for those attendees who were not attending that previous session. I'm going to stay on this just for a little bit longer till I finish it up. We have taken the trade on April 19 when everything looked fine and the market was going high, and it was a bull put spread on which we were anticipating that the 438 put is going to expire worthless. So let me now show you that's the price right here on S&P that gets multiplied by 3. And the reason why multiplied by 3, reason why it gets multiplied by 10 is because it is the bigger one, right? So this is the one that actually got hit. And to find out exactly what we got filled on that, I'm going to jump here on the 419, which was when he took that trade. Okay, and we have gotten for that $1. Okay, so if we gotten that for $1, this particular trade has quite a bit of significant loss, and that significant loss is basically, let me just put here so I have a room to type the information. So if the credit was taken of $1, that's the credit taken, and then we are exited for a 310, that's the loss of the $2.10, right? So had we held that all the way till the end, because that spread was a 5-point wide, right, that would be the $500 loss, right, minus the credit. So one of the things that I was showing you here that you can do when you go over here, you would actually see that we took $1 subtracted from this $5 would be $400. So at the end, the fact that we took a loss of the 210 is that we were actually not taking the whole loss, not taking the whole loss. So Mark, whenever you check, you can type it. So the question now becomes, what do we do for the next week? So one of the things that we can do for the next week is to revisit again our daily chart on a SPY, and I'm going to now be inserting the Bollinger Bands on it, and when we have a Bollinger Bands on it, then we actually know whether or not we are going to be inside of the standard deviation or outside of the standard deviation. So when we insert this, we are seeing right now we're outside of the standard deviation. So attempting to go short right now at this point, it might not be the 100% thing, but also could it be that we go outside of the standard deviation even more? Okay, I'm reading Mark's notes here for a moment. Okay, I'm going to revisit this a little bit later. Let me just now plan with the trades right now over here. So when this trade has pierced outside of the standard deviation, then there's a high chance that at one point, just like over here in the past, the price might actually snap back in. For instance, in this particular case, the price on a SPY was outside of this area by quite a bit. So if I now measure this, this is about the same amount that is now. So all the traders who are now considering to perhaps go short, they actually might pile up short, and then the price action, it could actually move back in a range. If it moves back in a range, then they're going to have another losing trade. So at this point, it's best to actually let the market show us the face. But just like I was pointing out to you, line on the sand, line on the sand, line on the sand. What do we mean by that? That's mean that looking at the three markets and drawing the line at the same time and kind of monitoring it, it really assists to know whether or not we're on the right side of the trade, whether or not we're on the right side of the trade. So let me see here. I'm reading the text that he typed in on IWM. I think I also had that IWM trade. So let me now revisit here IWM trade. Okay. So we had the IWM trade that we put in for 13 cents credit. And I know we had a stop loss on it. So what I'm going to do now, I'm going to actually jump this also to the 23rd. And I'm going to just filter for IWM and see how is the outcome of the IWM. So IWM, I got one in for 13 cents and one in for the 12 cents. So I had the aggregate at the 12 and a half, and I got punched in the face and got filled at 34 debit. So again, that should be considered success, because the fact is that I could have lost more, but in reality, I got stopped out at 34. In your case, Mark, you said that you actually got filled at 41. So there was definitely a slippage in a real time versus what my paper account is showing. And over here we have a SPY. SPY, you actually bought back for 45 cents and received 23. So that means every one of those trades that we have placed were not profitable because of the fact that market turned around and has gone lower. It's turned around and has gone lower. Okay, so let's now go to the plan for the next week, right? So one of the trades that I'm considering for the weeks is not necessarily the SPY, because one of the things when you get punched by the SPY or punched by the IWM is to instantly like, oh, SPY took my money, or the IWM took my money, and then you go in revenge trading trying to get the money back from the very same product that you had the previous trade on. So at that point, you should actually not do that, not try to add more to the wound, but you should actually look for the product that look way better, right? So I was looking at XLP, which would be the sector that tracks the utilities and not the staples, right? And I'm gonna actually just show you here how you can actually know the sectors which are which. In a FinViz, you just need to type in XL and you get the listing of all the sectors. Obviously, B is a basic material, C is a communication that is getting killed, and then you go through every one of them and there's XLP here. So now, the moment I click on XLP, you will see that the XLP has been really in a straight move up, right? So if it has been in a straight move up, this XLP, it looks to me, if I'm going to anticipate, due to the fact that the SPY and all these major markets are stretching the standard deviation lower, there is going to be at one point probably that snap effect that price is going to go back in a range, right? Then I don't necessarily want to be in these weak ones. I want to be in stronger ones. And I'm now picking the two that, in my opinion, are the strongest one and still have a trend intact. And what I mean by that, if I now draw simply from these lows up to here, I'm actually seeing that we are approaching the trend line, and this trend is intact. And if anything is going to recover, then there's a high chance that the staples are going to recover. So I am considering going long on a staple depending what the context is actually pointing out to me starting on Monday. So what I'm doing now next is I'm also looking at the Costco. Costco is another one that I'm considering trading. Now notice, and I'm going to ask all the attendees here to use a chat box and to type in which one looks better, the Costco or the staple in terms of the trend. So this is very steep move up. The trend is intact because the buyers have been stepping in, buying. And a Costco is also, when you go to Costco, you actually have to wait in line to pay. So that's mean the gas price at the Costco is more attractive than any other place. And trend over here was intact, and now it's broken, but we are coming into this horizontal um, demand zone and horizontal support, right? And I'm keeping this on the chart and considering it. Yeah, you're right, JV. We're definitely looking better on on the staples, right? Because if I go over here and just let me get rid of this, type in Costco, you will see that Costco is coming here at 570, and that's exactly what we have here, 570. So we can definitely look at the Costco and staple and consider which one looks better. However, we're going to do that by looking at the footprints. We want to make sure that we are looking at this, we know where the footprints are. So I'm going to use the Bollinger Bands here as indication where I'm going to be putting my bull put. So that'll be 550. So 550 would be the area for me to consider doing the bull put. And again, I might actually choose over the Costco staples, but right now I'm starting with the, and we're gonna do just for a week because this thing is gonna either do that or it's not gonna do that. So 550 is something that I'm looking here, 550, and we have quite a bit of liquidity. Now that the market is closed, the bid and ask spread is quite wide, and this bid and ask spread is over here. This bid and ask spread is right now over 44 cents. So let's see if we have any. If we were about to do again a $5 spread, selling the 550 and buying the lower one 445, we're getting about the 75 cents. We're getting 75 cents. I'm going to just take a note of that in my notes here for a future reference, that if we are now considering doing the Costco trade, selling the 550, buying the 545, and this is a put, and getting the credit of the 75 cents, I would like to compare that against the staples, because on the staples we're going to be considering similar trade. So this is a Costco trade that we're going to be considering, and rule is going to be in both of them we're going to invest the $500. In both of these we're going to invest the $500, and we're going to see what do we have here on a staples in terms of the technical analysis. So I'm going back to the chart of the staples, and when I pull up the staples, I'm using this 20-day exponential moving average, just like on a Costco I was using this lower Bollinger Band as my area. Why would I do that? Well, the reason why I'm doing this, because this exponential moving average, it's below this particular level. Yeah, that's right, Mark. Like staples have a steeper trend, but the price is still above the 20-day exponential moving average and is still within the Bollinger Band. So I'm now considering right here this support to hold. So again, this support to hold, but I want to give myself protection, and I'm going to actually use this exponential moving average right here at this particular level as my area to place the bull put. So I'm looking now around the 77, and I'm going to make again 5 points wide on a staple, and I'm going to still use a April 29 expiration, because this is going to be I don't want to call it in and out trade because that doesn't make sense, but within a week trade. So obviously we don't have a 77.50. Well, we do have a 77.50, but right now the liquidity is really, really bad. Now, obviously over here we have a huge activity that if I did not look at 76 volume, I would completely miss it on a chart. So I'm going to revisit the chart one more time to see where that 76 area is. So my line that was here is now being moved down here. And the reason why it's being moved down here, because the big institutions have left the footprint. So they're saying, look, no, we don't want to risk here 77, because there might be even here tiny little gap between these two points of data. They're playing safe at 76. So what I'm considering right now as a better choice to my previous trade that I had on would be simply to make the spread wider, 76 and 71. So I'm going to be, in this case, consider selling the 76, buying 71 to be consistent with the $500 investments. Okay, so this one and this one are now similar. Now I need to price this and see what is going to happen. Now be aware of it when I bring this up. It is skewed. Obviously, the reason why it's skewed because market is right now closed, and over here when I bring to 71, you see how they price it everything at the zero. This is not going to price right. This is definitely not going to price right on this particular platform. So 76, see what they did with 76. This is so skewed that almost like it doesn't even make sense to do it. So I mean, I can press the mouse here and say sell vertical, change it down to the 71 and get some skewed numbers. And it doesn't matter if I get the skewed numbers over here or if I go right here in our platform, select the chain, go into the XLP for this upcoming expiry, select here the bullish trade, and then go where it says the edit and just adjust this to the same strike price. It's still going to be skewed. It still is going to be skewed because the pricing on the one is going to be pricing on all of it, because these are the exchanges that are giving me these numbers. These are the exchanges that are giving me these numbers, and they're skewed. So I'm doing now 77 and 71. When I click OK, I still get some kind of negative number, which just doesn't make sense to do it. So if somebody says you need to pick the one of these two trades, obviously the trade that I would pick would be then Costco, because the Costco looks a better trade. So let's now entertain the Costco in a greater detail and build it and then consider it in comparison to maybe another trade. So we don't have within a Costco two choices to select. So again, the logic is to trade the stronger in this environment that is currently being weak. So I'm going to edit the spread. Just a reminder, what numbers did we use? 550, 545. Those are the numbers that we were using. So I'm changing now. Yeah, on XLP was supposed to be 76 with the 71. Good catch, good catch. So one more time here, looking 550, 545. So 545 is being bought. 545 is being bought. 550 is being sold. 550 is being sold. And we click this, and now we have that 75 that we actually calculated. So here's my 75. Here's my 75. I'm going to put this right here as example. Now, I'm going to do also another thing which makes sense to do, and that is to have my risk and reward explained. Where's my break-even price? How much am I risking? And this. So I want to make sure that this is all correct. 75 cents. We're risking the $500. So we're then having exposure here when I bring it up of, and I don't know why they have here 50 cents, like this is really 75 risking the 425. I don't know why they put the 50 cents. It must be some. And then it says, where is the break-even point? Well, we can pierce to 550. No, not that we want the price to pierce, but let's just say if the price action does some crazy thing and pierces through my 550 right here, if it pierces by the 75 cents, and when you subtract this thing, then you know that your break-even point, and it doesn't matter if it's up or down, is at 549.25. 549.25. So this is one trade. I want to do another trade on a Costco, but this trade on a Costco, I want to look at where the footprints are of these institutions. I'm going to revisit this one more time. I'm going to delete this, go back to the Costco, and I'm going to be using the volume and open interest to visually see where is it that institutions are doing something. And when the numbers are becoming zero, meaning the single digits, right? 6, 8, 7, 14. That means there's no activity. I'm looking only for a 3 digits activity. So there's obviously here 3 digits activity around the 510. Now, when I was learning this, the market maker who was teaching me said it needs to be minimum 200 contracts. When these two things added, this could be 200 contracts. And I'm seeing also here activity that has triple digits. Now, what I don't like about this is a $15 spread. 525 minus 510 is a $15 spread. So we have picked the one over here. Let me just change the color here to blue so you will be aware of it. That we have picked these two as our first choice. And obviously liquidity on these is looking good. Now I'm going a little bit lower, and I'm seeing that there's a possibility of doing the activity at 525. 525. So let's revisit that. 525. So I'm now selecting selling of the 525 and then protecting whatever I choose to protect myself a little bit lower in a moment, right? But that would actually give me a lot more space to be wrong, because right now the Costco is sitting here at 571. So at the 571, let's just say 570, we only have a $20 cushion. $20 cushion. Over here, if Costco is still at 570, our cushion is so much more significant. So I'll try to price this, but again, be aware of it. This might not work out in terms of the richness of the premium. richness of the premium. So what I'm going to do, instead of having the 525, 520, I'm going to be altering and bringing a little bit more credit in, because this is pathetic. Getting only 12 cents and risking the $4.88 just doesn't make sense. So what I'm going to do right now, I'm going to edit, and I'm going to put the one that we said down there at the 510. So 525 is being sold, 510 is being bought, and when I look at this now, it's actually slightly better. Okay, so let's entertain that possibility using again the FinViz, and no, not the FinViz, using the top platform. So we are going this all the way down to 510, all the way down to 510, and we're doing this at 525. 525. 525, we're pricing it, and let's take a snapshot. Let's take a snapshot again. Put it in the document side by side. So this is a 45 cents, and I also need to take a snapshot of this. How much are we risking? How much are we risking? So because it's a $15 spread, we're risking here way more. So I still like the first trade better than the second trade. Because this risk to reward is just not something that sits that well with me. Because if I'm risking here 45, if I'm gaining the 45 and risking this rate of return is barely 3%. 3%. Now, on the other one, we had the 75 and we were risking the 425. So that is a 17%. So between the two, I think I need to find a compromise. And what I mean that I need to find a compromise, I'm going to revisit this area. So one more time, we were talking about having this as one possible trade, and then having this blue line right here, another one. How about if we go right here in the meat of the market and consider maybe 540, 535. So I'm going to be considering doing the 540, 535, this green rectangle. Now, does the volume support this? Yeah, we have a triple digits, and they're going to do the 5. Now, before I do it, I want to again revisit the chart and make sure that the chart is actually telling me that most likely 540, 535. So 540, 535 is my right choice, right? So we're now looking at the 540 and buying the 535 as the right choice. So I'm revisiting again the chart because it's all about the chart. Where is this looking on a chart? So I'm going to get rid of everything here for a moment. I'm going to enlarge the Costco, and I'm going to now look at the chart. Okay, so it would be right in this area right here. If I take this, point out to you 5. Okay, this is a level right here. This is a level, and I kind of like that. Usually, I like to look at the two different platforms to kind of visually gauge this. So approximately this would be the area. So what is there that is actually protecting me on the way down? On the way down, there's this congestion area that needs to be cleared up between a 565 to 549, and then I'm down here at the 540 at this area. Okay, honestly, the chart at this point looks probably the best in the terms of my my placement of the bull put spread. I'm going to revisit this one more time with the Bollinger Bands. So when I look at the 540, it's outside of the Bollinger Bands. It's right here. So this is, in my opinion, way better trade, and we're going to now build it from the beginning to the end. So I'm going not the long call, I'm going the bullish. I'm doing the bull put spread. I'm editing the spread, and again, I'm sticking in a short-term time frame, changing the lower one to 535 first, 535, changing the top one up to 540, and placing it and pricing it. So we get the 44 cents, okay, and we are risking the $4.60. So this is about 10% trade, but it's very, very conservative. It's very, very conservative. Okay, so the one that we are doing here is 540, 535 with 535 being sold. So let me now have the things from the top to the bottom spelled out so that there's less confusion, and I'll probably put that in the notes. So Costco is currently sitting at the 571. So we are going all the way down here where is selling to open 540. So we have a protection of the $31 of the down move. We're buying to open 535. So the spread is 5 minus the credit of 44. That gives us a risk of the $4 and 6 cents. So 56 cents. 56 cents. And when I divide this, so I'm getting 44 while I'm risking 456. It's about 10%. 10%. But what is more important is my protection, right? So now I can look in a week, could this actually move down that much in a week? So I'm going here where it says the study average true range on this one is average true range is at $13.52. So I think this trade should do the trick. So let me now capture a few more things here before I have this thing done. So did I close? Okay, I'm gonna rebuild this one more time. So Costco, edit the spread, bullish, bull put, select April expiration, 535 is being bought, 540 is being sold, price it, copy it, get the risk graph, take a picture of it, 456. 456 is just like I pointed out here. That's the amount of loss, and I'm going to take a snapshot of this risk graph. Okay, this risks way more money than what is actually making, so be aware of it. That's the one possibility. Now, Another possibility, and I know I have about 10 minutes that I can discuss, if we lift and go back in, then is there a better choice? Well, as a traders, we always need to think about looking for a better choice. So when I'm looking for a better choice, I'm going to just float this and move it to a different screen so I can discuss this in a moment. If the price really start lifting and go back in, if the price start lifting and we're no longer sitting here at 570, we go back in, we are 580, then what is the trade that we can do? In that case, we can actually trade something that needs to move up. So if I do, let's say 575, 570, 570, 570, that means this is now directional. The previous was non-directional. Then I'm actually getting the $2.62 of the credit while I'm risking only $2.38 of the credit. So let me put this side by side because I like to keep quoting the Albert Einstein saying that I like to have a always comparison of something with something else, right? So if I now have a two columns here, and be aware of it that in this case, Costco is still gonna be at 571, but I want a directional move up. I want a price to go up, and I want to then sell to open 575, and I'm going to be then buying to open 570. So at the beginning, the price is now at 571. But if the price lift and now it's expiry, so now let's say now it's expiry, and we're sitting at let's say 577, just as an example. Then my 575 at the expiry is going to become out of the money. So will this other one become out of the money. But the outlay of the capital, it's going to be so much better. The outlay of the capital is going to be so much better. So I'm going to now have this side by side here so you will see it where the outlay of the capital is going to be. So good thing I didn't close this, so I can just bring this in quickly and alter these things. So I'm going into the edit. I'm changing this to 575 because I'm aggressive. I want this thing to lift. So this is what it's called at the money, and this is gonna be then lower one. Okay, so when I reprice this, it's giving me $2.63. So now I'm gonna take that snapshot right here, just the part that I need, 263, 263. So I'm doing here 263, right? And over here, I'm going to make sure that I get the risk graph of it. So here's the risk graph of this particular trade. And I'm taking a picture and putting it in a Word document. So when a session is over, I can actually put it in the notes and it can be easy to track. So we're actually risking less to double the account, That's what's really going on here. That's what's really going on here. So what do we do today? Today we went over what the market condition was. Then we had examined two particular products. We looked at the Costco, we looked at the staples. The staples looked good, but what the problem was with the staples, that the pricing of the premium just wasn't there. So the pricing on the premium on a XLP that looks amazing in terms of the chart was too steep, and it has a potential of coming down. Knowing the Costco is still going to be around no matter what happens, we then entertain Costco. On a Costco, majority of our session was spent on figuring out where should we place the bull put because we're anticipating the snap. And when we looked at the conservative area involving the 540 and 535, our trade on that particular conservative area was giving us barely about the 10% rate of return. 10%. Now, what is it good? It was good that we had the protection, and market can go sideways, up or down, as long as it doesn't go down more than 31. So this was then non-directional. Okay, so this was non-directional for a simple reason that we have involved this particular strike prices that I'm putting here in the bold versus directional trade. And this directional trade means that we want a Costco from current price of the 571 to move up, and we'll be looking here at least 4 points. 4 points. We glance at the Costco in terms of the average true range, and we notice that ATR right here, it says a 13. So it's not unrealistic to expect that we can move the 4 points. The only question is it's going to move up or down, right? And then we know that this directional trade with the move up of the 4 points, if everything works out, is going to be giving us the rate of return. And again, over here, I'm going to bring the calculator. I'm going to just show you this is going to be more than 100% if it works out, because we are making $262 on an investment of the $238, and that is 110%. Now again, which trade we're gonna take, it's really completely up to you. Somebody put the gun to my head, they said choose one, I would definitely choose this one, because even if I lose less. While over here, this trade right here, it sounds very much similar to the one that we had on a SPY and we got hit. What about the stop and the targets? Where would you place them? Excellent question. So let's now revisit the chart one more time and just discuss this. When I put this at-the-money trade, I really need to wait a day before I put the stop, and then I need to look at it where the price action is. As of now, be aware of it, because it's at the money and I put the stop, I will right away get stopped out. So what I'm going to do now, I'm going to actually, you see, because the market is right now closed, they don't show me high and a low, so I still need to go then on the FinViz and show you on the FinViz, in this area right here, all the relevant informations are present. If you hold the mouse right here and look in this area where I'm circling, all the information is present, okay? So low 571, high 591. So this would be the range where that price action was that particular day. So I would first say put the trade in, and I personally would probably put it in towards the end of the day, because if I put towards the end of the day, then I would be able to figure out exactly where my stop should be. My target is actually on this one very simple. My target is when the price is above whatever my sold strike price is. So in this case, my sold strike price is, and I'm going to put this in the red so it kind of stands out, 575, right? So if the price goes above the 575, I'm already profitable. Another way to manage this, and I'm answering here this question about the stop and the target. After I mentioned the stop can be put place when we know when the low of the day is. I'm talking about the target. Target can be then placed once when the 575 has been breached to the upside. Now, if I place target and I right away get filled, then that's then target that is based on stock price. I personally prefer to use the premium, because if I have gotten in here the premium of $262, and the next day, so let's say target, the next day Costco rallies to, let's make it 576, then I could close the spread for $1.30. I would consider this very profitable trade. Why? Because I took in $2.62, 262, and now I'm closing it for $1.30. That's made I made $1.30 or $130 virtually within the one day. So I made in that case about the 50% of my maximum profit. So Mark, if that makes sense, please type it in the chat. It makes sense, so then I can kind of start wrapping up the things. So one more time, we looked at the market, we looked at the staples, we decided staple is not good pricing of the premium, not the chart is not good. We looked at three different trades, bull put trades on a Costco, and we decided to do one that is directional. The one that is directional, because now we're finally reaching the market that is a directional market. And if the market goes up, most likely the strongest of the strong are going to go up. Like a Tesla is probably another one that is going to bounce very hard. But that's maybe for another lesson. So it's over an hour. I want to thank you for attending this, and always stay hedged. Always stay hedged. Okay, have a good day, Mark. Have a good day, JB. Look for the 50% drop in the premium. You got it. You got it. That's the one of the rule of the thumb. Okay, have a good day, and stay hedged. Bye now.